So in the previous session, hope you all aware what is fundamental analysis. Next, it is going to be a types of fundamental analysis. What is the purpose we are using fundamental analysis? You all know that to arrive the intrinsic value of a security, which can be useful for the investor to decide to invest in such security or making some investment decision. Either they are going to buy the security or going to hold the security or going to sell the security in the market. The type of investment decision is going to be taken by the investor based on the fundamental factors, including the factors which are related to the economy, the factor which are related to the industry, factors related to the financial factors of a company. In this type of fundamental analysis is focusing what type of data is being taken for the analysis purpose. We can classify into the qualitative analysis and quantitative analysis, where the qualitative analysis is not focusing on the numbers, beyond the numbers. What are the qualitative factors which influencing the performance of a security in the market is being analyzed. In that, we call it as qualitative factors. So in that, the qualitative factors, it is taken the account of information which is considering apart from the numerical values, the factors related to the management, the experience of the management, like their expertise in different fields, like their expertise in financial services, or there may be expertise in manufacturing sector. With respect to that, they can be able to add the value to the production system of a company. So likewise, the kind of factors are going to be taken into the consideration, like management experience, like the performance of a management, decision-taking capacity of decision-making capacity of an organization, like the system what they have been followed in the organization, like the corporate governance structures followed by the organization, and like the performance of industry, and like the competition is prevailing in the market, the position of a company in the market, the decision making towards the industry in terms of deciding authority for price for the securities which can be traded in the market, or some factors we can say it is a qualitative factors in nature. Those qualitative factors are contributing value or used to identify the value of securities in the market. That measure of deploying the qualitative factor to estimate the intrinsic value, we call it as qualitative analysis, the category of fundamental analysis. Then the next one is a quantitative factors. The quantitative analysis, the numerical values, statistical values are taken into the consideration. The statistical analysis is being performed with the required data, can be used to derive the intrinsic value of a security. So with that, it is related to the information which was shown in the financial statement of the company. It was shown in the profit and loss account. It was shown in the balance sheet of a company with the different schedules of a company, which can be useful factor to determine the value or to determine the performance of a company. So with that performance, they can be able to estimate the intrinsic value of a security. It is about the fair valuation of security, at what price the investor needs to buy that particular security, and they will be able to measure, compare that performance with the market for taking a decision. Either they are going to buy the particular stock or going to sell that particular stock in the market, or going to hold that particular stock for a period when they are going to wait prices goes up in the market. The reason, the kind of things might be going on in the market, which we can say is a quantitative analysis. Majority of the researcher in the field of fundamental analysis, they are evaluating or taken into the consideration of quantitative factors for calculating or using some complex calculation to derive the value to take the decision in the market. This analysis helps to evaluate the investment opportunities, which type of security can be bought, which type of security can be sell it in the market, or what type of contract can be created, can be entered by the investor into the market, which can be favorable to the investor. The kind of decisions are going to be taken by using the numbers or using some quantitative factors in nature. So like for example, the informations, revenue generated by the company, profit margin of a company, return on equity, and like the future growth potential of a company estimation, whatever done by the researcher, and like the financial ratios. It is like simply express the relationship between the different factors are taken into the consideration. Like for example, the financial ratios can be useful to determine the liquidity position of a company, how the company can able to meet out their short-term obligation, and the solvency position of a company, long-term obligation, how a company can able to meet out, and the activity of an organization using the turnover ratios, and the company can able to understand the profitability of a company over the period of time. In terms, they understand the relative components the direct expenses, indirect expenses, direct income, indirect income, what is the revenue generated by the company, what are the appropriations, can be able to identify from that the profitability of a company, the marketability of a company, relative performance in the market, how does the internal performance can be boost up the growth for the company towards the external performance, how the wealth maximization process is going to be happens in the market is being identified by using financial ratios. So these are the basics of the fundamental analysis using the qualitative analysis as well as the quantitative analysis, using of the important ratios which we call it as a financial ratios in fundamental analysis. How we can use that? So it can be classified, different ratios are taken, as you all already aware, financial ratios which we can classify into the liquidity ratio, solvency ratios, profitability ratio, marketability ratios, and turnover ratios, where the appropriate ratios can be used. Here some important ratios are taken, normally taken by the investor for understanding about the market, understanding about the market condition, understanding about the financial performance of a company is being identified. With respect to that, the first one ratio is a price earning ratio. Majority of the investor are taking this particular ratio. For the reason, this is widely used financial ratio analysis. It is even being publicly available information, publicly available the key financial indicator for all such investors in the market. With that, the basis, the investor can be able to identify the relative performance of a stock in the market. With that, how the price earning ratio is calculated, market price of a security is being divided by the earnings per share. It is calculating the external ability of a company, external performance of a company, external value of that particular share is being compared with the earning capacity of a company. This is being calculated. We can say it is price earning ratio. Whether the price earning ratio, lower price earning ratio would be preferred by the investor to make investment, because the lower PE ratio can give the higher yield to the investor. Lower PE ratio is considered that the particular stock is undervalued, because whenever the investor is going to buy such shares, they are going to search with that the shares or the kind of securities can be undervalued in the market, because that going to give the profit to the investor. As if it is an overvalued securities, it is not possible to predict that when the prices of such stocks or such security is going to fall in the market. So with that, undervalued securities are advised to buy, whereas the overvalued securities are advised to sell it in the market. With respect to the price earning ratio, it is understand that lower PE ratio implies that the security have been undervalued. It means those security is being closely related, the value is being closely related to the earnings of a company, earning stability of a company. So it is not being exposed towards the market conditions. So those stocks are classified as a low PE stocks or undervalued stocks in the market. One thing. A second one, how can I measure that the particular stock is low PE or higher PE? There are industrial PEs are also available. So whatever the industrial PE, in case if your stock, you have chosen that particular stock is relatively lower compared to the industrial PE, you can say that particular stock is undervalued. In case that particular PE ratio is equal to the market PE ratio, you can say it is being hold that particular decision. Whatever the kind of things are going to happen in the market, either it is going to overcome the market PE ratio, or it is being lower the market PE ratio. Lower the market PE ratio, advised to buy. Over and above the market PE ratio, advised to sell it in the market. The way in which you can able to classify which one is a low, which one is a high. We can't say low is a 1 or low is a 5 or low is a 10 PE ratio. Not like that. It is based on the condition prevailing in the market. What is the overall market condition? What is currently prevailing in the market? With respect to that, you can able to identify the fair valuation of securities. In terms, you can use the price earning ratio. The price earning ratio can be used for understanding the external performance of a company in the market, and internal financial performance is being compared. Lower PE ratio, it indicates that the security is being undervalued. Maybe the kind of information, the earning stability of a company is not being identified by the investors in the market. Those stocks are advised to buy it in the market. In case you have already owned that stock, but the stock has a higher PE ratio, is advised to sell it in the market, because those stock is already overvalued in the market. So with that condition, you need to know about the price earning ratio. The second important aspect is a price to book value ratio. The computation of price to book value ratio, it is calculated current market price of a stock, current market price of a security divided by the book value of a stock is being compared. The relative performance is being compared. External price and internal price. External price, what we call it as a current market price. Internal price, what we call it as the book value of shares. Both are being considered for the calculation of price to book value ratio. So the price is being calculated, the current market price divided by book value per share is calculated. How I can calculate the book value of shares? Normally the book value of shares are calculated from the net worth of the company divided by number of outstanding equity shareholders. With the value, you can able to identify the book value of shares. The book value of share can be useful to identify, or can be used to compare with the current market price. You can able to know what exactly going to happen in the market. In case that the price to book value ratio is low, it is advised to buy, because those stock is also being undervalued in the market. It is not exposed towards the market conditions. Majority of the investors are not paying the higher price for purchasing of that particular stock, but relatively financially that particular stock is sound in the market. So those stocks are advised to buy. However, the definition of the lower, that may vary from sector to sector. As similar to the price earning ratio, the sectoral PE ratio, similar to that, the price to book value ratio needs to be confirmed with respect to the specific sector. Maybe a banking sector. If I'm going to take the State Bank of India, with the State Bank of India, I'm going to calculate the price to book value ratio. That ratio is going to be compared with a sectoral PE ratio, sectoral price to book value ratio. With that, I can able to determine that whether it is being undervalued, whether it is being overvalued. With that, I can consider the market PE as a fair valuation. The assumption that have been taken for the calculation. And the other types of PE ratios, or other types of ratios, the financial ratios, or the return on equity. It means the portion of profit available for equity shareholders being divided by the shareholders fund. Equity shareholders fund is calculated. It is the amount of net income returned to the percentage of equity, shareholders equity. So with that, the investment, paid up capital of a company is about 10 lakhs, and the profit have been received after all the appropriations. The earnings available for the equity shareholder is 1 lakh. Hence, the return on equity is 10%, 1 lakh divided by 10 lakh, for example. So similar way, how it is going to be calculated, the return on equity is calculated net income divided by average shareholders equity, or average shareholders fund. With that, it is going to be calculated. How the net income is calculated? Either the profit after tax is taken, or the profit after tax minus preferential dividend It means whatever the portion of profit is available for the equity shareholders, with that is being taken for the calculation of return on equity. And similar to that, the debt to equity ratio, what we can say, the debt equity ratio is the measuring the relationship between the external fund and internal fund, outsiders fund and the owners fund. Outsiders contribution and the owners contribution is being measured under the debt equity ratio. The debt equity ratio, which measures the relationship between the borrowed capital, which what we call it as debt capital, and compared with the capital which is contributed by the shareholders, equity shareholders of a company, is being identified. It is calculated with the total liabilities divided by shareholders equity. It is going to be calculated. Total liabilities of a company is being divided by the shareholders fund is being calculated. The debt equity ratio is calculated. Whatever the long term or fixed interest bearing securities being issued by the company is being compared with the shareholders contribution, equity shareholders contribution, that we can say it is, call it as debt equity ratio. The rule of thumb, the companies with the debt equity ratio of more than 1 are considered as a riskier, because the external fund is more. Let you can take an example. The equity shareholders fund is 10 lakh. Borrowed capital in the market, borrowed capital from the market is about 20 lakhs. Hence, your debt equity ratio is 2, is considered as too riskier. Compared to that, owner's contribution is about 10 lakhs. With that, the external borrowing is about 5 lakhs. Hence, it is going to be the 50%. It means 0.5. Less than 1 is considered as low risk to the company, because they can able to repay easily. The owners can able to repay the fund easily. If external borrowing is increasing, is going to affect the profitability of a company in the market. That is, debt equity ratio is calculated. Similar way, another one important ratio, what we can call it as a current ratio. Current ratio can measure the short-term ability of a company to meet out its requirements. With that, it is a key financial ratio for evaluating the company's liquidity position, how they can able to meet out the day-to-day operations of the organization. It is can be calculated current assets divided by current liability. How current assets and current liability is calculated? Current assets, the assets which can be easily converted into cash, we can call it as current asset. For example, cash, cash in hand, cash at bank, closing value of stocks, including the kind of inventories owned by the company, and the closing value is considered as a current assets. And the debtors, the customers who bought the product on credit, can be classified as debtors and accounts receivables. And like the expenses which are already paid, we can call it as prepaid expenses. Accrued income is being classified as a current assets. Similar way, the current liability is calculating, is being identified the current liability, the kind of the borrowings, the kind of liability which can be for a specific period of time, which needs to repay shortly. Those kind of liability is classified as a current liability, like overdraft offered by the bank, cash credit, trade credit, creditors that you need to repay the amount to your suppliers. It's like outstanding expenses, all such things that comes under the category of current liability. So the way in which it is calculated, and the rule of thumb, the company should have greater than the 1 the current ratio would be preferred, but the current ratio should be also having some limitation up to the maximum of 2. If it is go beyond that particular level, is going to affect the organization's ability to focus on the long-term aspect. It is in terms affecting the policy of our organization, in terms go for the diversification plan, or like the expansion plan of our organization is being affected. So that is what the reason that the current ratio also should be in limit. That should be preferred by the investors, preferred by the company too.